Welcome, everyone, to this explainer. Look, if you've been watching your fixed income returns, things like GICs or bonds, just totally struggle to keep pace with the real cost of living, you are definitely not alone. Inflation has this nasty habit of silently eroding those safe returns right out from under us. So today, we're tackling the urgent need for a better wealth-building strategy, specifically one that works hand in hand with the Canadian tax code to keep way more money in your pocket. Consider this famous thought from John D. Rockefeller, who said, "The only thing that gives me pleasure is to see my dividends coming in." Now, okay, I might not go quite that far, but the sentiment is absolutely spot on. When you harness the incredible, almost magical power of long-term dividend compounding, it completely flips how you view your portfolio. You're not just waiting around hoping a stock price goes up, you're actually building a financial engine that pays you cold, hard cash year after year. And to prove just how powerful this is, you have to hear the staggering story of Grace Groner. Grace wasn't some Wall Street insider. She worked as a secretary at Abbott Laboratories and bought exactly 3 shares of the company's stock for about $180. That's it. She held on to those shares through decades of market ups and downs, stock splits, recessions, the whole shebang. By simply collecting and reinvesting her dividends, that humble $180 grew to over $7 million by the end of her lifetime. Literally, $7 million. That is the kind of compounding power we're diving into today. Okay, let's dive into this. Here is our clear roadmap for navigating the Canadian dividend landscape. We'll start with the magic of dividends, decode what eligible dividends actually are, explain return of capital, highlight the top Canadian dividend payers, and wrap up with the tools you need for success. Section 1. The magic of dividends, escaping the interest tax trap.
So, the core problem facing a ton of investors is this massive misconception that all investment income is treated equally by the government. It's totally not. If you earn interest income, say from a GIC or a regular bond, that money is fully taxed at your marginal rate. Depending on your tax bracket, you could literally be surrendering roughly 50% of it straight to taxes. On the flip side, eligible dividends and capital gains get highly favorable tax treatment, which makes them a mathematically superior choice for maximizing your after-tax wealth in a taxable account.
Section 2. Decoding eligible dividends, the tax shield. By definition, an eligible dividend is a distribution paid to Canadian resident investors out of corporate income that has already been subject to the general corporate income tax rate. Basically, large Canadian public corporations already pay a pretty high rate of corporate tax. To prevent that exact same profit from being heavily taxed a second time when it finally hits your personal tax return, the government gives it preferential tax treatment. It's a system of integration designed to keep things fair.
Now, what's really interesting is how this somewhat confusing integration actually functions as your personal tax shield. When you file your taxes, your eligible dividend is first grossed up by 38%. So a $100 dividend suddenly looks like $138 on paper. I know, that sounds bad at first. But then you get the dividend tax credit. This credit is specifically designed to compensate you for the taxes the corporation already paid. The final result? A drastically lower effective tax rate on that income compared to your regular interest.
To put that into perspective, the result of this tax credit is honestly staggering. Because of this integration shield, a Canadian resident with no other sources of income can earn over $53,000 in eligible dividends without paying a single dime in federal tax, zero. And the provincial tax on that $53,808 is also zero in British Columbia, Ontario, Alberta, and several other provinces. We're talking about over $50,000 entirely tax-free.
Section 3. Return of capital explained, the deferral strategy. Now, return of capital is a completely different type of cash distribution, and it's super appealing if you need stable cash flow. It works in 3 specific steps. First, you receive cash flow that is non-taxable in the year you receive it. Why? Because the fund is essentially just giving you some of your original invested money back. Step 2, because you got your money back, this distribution lowers your adjusted cost base, or ACB. And Step 3, the taxman still gets his due, but not until you finally sell the investment. You're effectively deferring the tax into the future and eventually paying it as a capital gain. So where do we actually find these ROC distributions? Well, they're really common in flow-through investments. Think mutual funds that pay a set monthly distribution, real estate investment trusts, limited partnerships, and mortgage-backed securities. If you hold these in a taxable account, you get fantastic current cash flow. But just remember, you absolutely have to track your adjusted cost base carefully over time.
And here is an absolutely crucial detail for anyone planning their retirement. Because return of capital is not considered taxable income in the year you receive it, it will not trigger clawbacks on income-tested government benefits like Old Age Security, or OAS. It protects your peace, and it protects your cash flow, right up until the point you sell the asset.
Section 4. Top Canadian Dividend Payers. Where to look?
So the crucial point is, where do we actually find these highly coveted Canadian eligible dividends? You want to look toward large-cap corporations with massive competitive moats. We're talking about the giants of the TSX here, the big banks with their literal centuries of uninterrupted payouts, the telecommunications oligopolies, essential energy and utility infrastructure companies, and the major railways. These are the heavy-hitting engines that reliably pump out those eligible dividends to Canadian investors.
But you really need to know what does not qualify for that magical dividend tax credit. Foreign corporations, and yes, that includes those massive U.S. dividend-paying stocks, do not get the credit. If you hold U.S. stocks in a taxable account, you are taxed fully at your marginal rate. The exact same goes for small Canadian businesses paying lower corporate rates, and most REIT distributions, which, like we just talked about, are usually classified as return of capital or regular income.
Section 5. Tools for dividend success, beyond the yield.
And this brilliantly illustrates our next point. It's not enough to just chase a high yield. You need a framework so you don't fall into a value trap. Looking at TELUS shows us exactly what a healthy framework looks like. Notice how over a 5-year span, the stock price appreciated, but more importantly, earnings per share climbed steadily, and the dividend payout stepped up right alongside it. It actually increased by 49% over that time frame. That is a masterclass in a healthy, growing company actually rewarding its shareholders.
To find investments like that, you need to watch 3 key metrics. First, dividend yield. That's your current payout percentage. But seriously, never chase a high yield blindly. Always verify the dividend safety rating. You want strong assurance that future payouts are secure. On a scale of 0 to 99, you're looking for a safety score above 40. Finally, check the dividend growth. A solid history of steadily increasing the payout means your income grows automatically, which is an amazing natural hedge against inflation.
Which brings us to one final, incredibly provocative question for you today. Do you know exactly how the income in your current portfolio is being taxed? If you're holding heavily taxed interest vehicles or just putting the wrong assets in your non-registered accounts, you could literally be leaving massive amounts of money on the table. Take a little time to review your holdings and make sure your wealth-building engine is running as tax efficiently as possible. Thanks so much for joining me on this explainer, and happy investing.